Four specific assets didn't just survive. They beat the market by margins that would make a hedge fund manager weep. And the working families who owned them came out of the Depression wealthier than the stockbrokers who jumped from the windows. Now, before I name them, I need you to understand something. The story you've been told about the Great Depression is incomplete. You've been taught it was a stock market crash. It wasn't. It was a monetary event dressed up as a market event. And the reason that distinction matters is because what's happening to the dollar in 2026, the debt levels, the central bank coordination, the quiet repositioning by sovereign nations, looks more like 1929 than anything we've seen in a century. So pay attention, because the families who knew what to own back then knew it for reasons that haven't changed. Asset number 1, gold mining stocks. Now I know what you're thinking. Gold is obvious. But here's what they don't teach you. While the Dow Jones lost 89% of its value between 1929 and 1932, Homestake Mining, the largest gold producer in America, went up 474%, 474, and it paid a dividend the entire time. Why? Because in 1934, Roosevelt revalued gold from $20.67 an ounce to $35 overnight. Working families who owned the miners didn't just hedge the crash, they captured the revaluation. The same setup is being constructed right now. Central banks bought a record amount of gold in 2024 and 2025. They are not buying gold because they expect the dollar to get stronger. Asset number 2, productive farmland. And I don't mean a hobby plot, I mean working agricultural acreage in the Midwest. Between 1933 and 1945, US farmland prices rose roughly 200%, while stocks went sideways. Why? 2 reasons. First, when paper money is being devalued, anything that produces real, edible, tangible output becomes the most valuable asset class on Earth. Second, the families who already owned land in 1929 didn't need a paycheck to eat. They were insulated from the labor market collapse in a way no stockholder ever was. Now here's the part Wall Street really doesn't want you to notice. Bill Gates is the largest private owner of farmland in America today. Institutional buyers, BlackRock, sovereign wealth funds, pension giants, have been quietly accumulating farmland for the last 15 years. They are not doing this for fun. They're doing it because they read the same history I'm reading. Asset number 3, long-dated US Treasury bonds. Now hold on, I know that one sounds wrong. Let me explain. Between 1929 and 1945, long-term government bonds returned roughly 120% total, including coupons, while inflation stayed low through most of the period. In a deflationary depression, the highest quality fixed income on Earth becomes a wealth preservation machine. Now, and this is critical, this asset only worked because the United States was on a quasi-gold standard and inflation was anchored. So the lesson isn't buy bonds. The lesson is this. In a deflationary collapse, the highest quality paper wins. In an inflationary collapse, the highest quality hard asset wins. The wealthy families of the 1930s understood the difference. Most modern investors do not. And right now, the Federal Reserve is signaling that it does not know which one we're heading into either. Asset number 4. And this is the one that built more quiet generational wealth than any of the others. Whole life insurance with a participating mutual carrier. I know, it sounds like the most boring asset on Earth. That is exactly why it worked. While banks were closing 9,000 times between 1930 and 1933, taking people's savings with them, the major mutual life insurance companies did not fail. Not one. They paid dividends every single year through the worst economic collapse in American history. Working families who had been quietly funding cash value policies for 10 or 15 years before the crash had a private bank that the government could not freeze, that no run could empty, and that earned tax-advantaged compounding while everything else burned. The Rockefellers used it. The Disney family used it. Walt Disney funded Disneyland by borrowing against his own policy when every bank in California turned him down. This is the asset Wall Street will never recommend because Wall Street doesn't sell it. And what Wall Street doesn't sell, Wall Street tells you to avoid. So look at the pattern. Gold mining stocks, farmland, long-dated quality bonds, mutual whole life insurance. 4 assets. 3 of them are tangible or contractually guaranteed. 3 of them produce income while you own them. All 4 of them sit outside the public stock market, which is exactly why they survived a public stock market collapse. The lesson from 1929 to 1945 is not that stocks are bad. The lesson is that diversification across asset classes. The system can't print is what separates the families who came out of the Depression richer from the ones who came out of it broken. If this video helped you see something Wall Street doesn't want you to see, hit the like button, subscribe, and turn on notifications. The next video in this series breaks down exactly which of these 4 assets makes sense for working class families in 2026, and which one is being quietly cornered before you can get in. This video is for educational and informational purposes only and does not constitute financial, investment, or tax advice. Always consult a licensed professional before making investment decisions. As always, stay focused, stay consistent, stay elite.